Okay, great. So hello, everyone, and welcome to More Talks from Thomas More University, where we present short, powerful talks devoted to spreading ideas, thoughts, and information to our community. I'm your host, Michael Orr, and I'm very excited to introduce our guests today. I just have a couple of quick notes. First, I want to remind you that this More Talk is being recorded, and a final recording will be made available on Thomas More University's Moreover website. We will be sending out a link to its location at more.thomasmore.edu after the presentation. If you find this talk engaging and thought-provoking, please feel free to share it with others. Second, I want to quickly go over the structure of the talk. Our speaker will be making a presentation, which will be followed by a Q&A session. So during this whole time, the chat will be open on Zoom and available throughout the presentation, and our audience can submit questions for the Q&A throughout. I want to encourage everyone to use the chat to submit questions for our speaker during the presentation so that your voice can be heard during the Q&A section. And without further ado, I am very pleased to introduce our More Talks guest speaker, John Bovard. John graduated from Thomas More in 2011 and went to work for Fidelity Investments and then Merrill Lynch before becoming the owner of Incline Wealth Advisors. John, thank you so much for joining us today.
All right. Thank you, Michael. I appreciate the introduction, and thank you for those that are on the line that have joined, and hopefully you can see my screen here. But yes, I am excited to be speaking to the Thomas More community. I'm an alumni. My wife is also an alumni at the school, and very grateful for the time that I spent at Thomas More. So, and today I'll be going over how to be financially prepared for your future. And like Michael had mentioned, feel free to post questions in the chat. We'll also have some time at the end to post questions, and I would be grateful to help assist you with any questions that may come up. So, but yeah, like you mentioned, so my name is John Bovard, certified financial planner, owner at Incline Wealth Advisors, which you can check out here. And we'll go ahead and get started with the presentation. So, how to be financially prepared. I've broken it down for you here in 7 steps. And just so you're aware of as well, Michael did let us know that he will be sharing these slides. So if you miss something or can't take down any notes, these will be available after the presentation as well. So just to quickly walk through what those 7 steps are. So 1 is obviously you need to set goals. 2, know your numbers. 3, build an emergency fund. 4, pay off debt. 5, save for your future. 6 is to diversify. And then 7 is to build wealth and give. And before we get into exactly what those 7 steps are and how you can go about doing that, one thing that I felt was important to mention, and it isn't necessarily a financial step that you can take, but I saw this quote from one of the vice chairmen at Blackstone, which is a large firm on Wall Street. And his advice was to network intensely. And the reason why I put this on here is right now we're obviously experiencing a lot of uncertainty in the job market, in the economy. I saw a stat from the Business Courier that there's been over 16,000 people that have been laid off from local companies. So one of the first things that I've seen, and you probably have seen this as well, what people do when they find the news that they've been laid off is they reach out to their network. You may have seen it on LinkedIn or Facebook or whatever that might be. So, luck, as the quote goes, luck plays a big role in life. And there's no better way to increase your luck than knowing as many people as possible. So if this is just kind of a quick side note to being financially prepared, if you have a strong network, that can always be there to support you financially and help you to land on your feet if the unexpected happens. So I'll go ahead and dive in here to the 7 steps. So the first step here is to set goals. And a lot of the common goals that I see, the most common one is obviously retirement planning, maybe vacation or purchase a car, purchase a home, college planning, things like that. These are all goals that my clients have. And these are obviously important to prioritize these because without giving your money, an assignment or determining what the purpose of your money will be, then really you're kind of saving and you're investing without a clear purpose. So a couple questions to consider when you're laying out your goals. One, obviously, it's what's the time horizon for this goal? Is it 2 years or less, 3 to 7 years? Is it farther than 8 years away? And that can then determine, what type of account you can put it in or what type of investment you can put that in. Another thing that I often like as well is, if money was not an issue, so if you could flip a switch and the next day you didn't have to work for money, how would you spend your time? What would you spend your time doing? And when I ask clients that question, it really gets to the purpose of, okay, why am I working? Why am I trying to earn money? What do I want to accomplish in this life? And a lot of the responses are, spend more time with family or travel, things like that. So it's good to ask yourself those types of questions to really figure out, okay, what's the purpose of my money? So, Michael, is there any goals that you've set for yourself financially, or any big ticket items you've been saving for?
Oh man, yes. I got engaged this past December. We are looking at getting married this next summer. So I have a lot of goals to plan for in this short term, saving up for a wedding and a honeymoon. Once we're done with that, there's going to be looking at purchasing a home, and after that, possibility of having kids in the future. So yeah, I'm at
Yeah.
a really big planning stage right now.
That is. Yeah, well, that's good. It's obviously important to get those goals laid out. So, and that leads me to the next step here, which is it's to know your numbers. So, look at, what we refer to as your net worth, or we may even refer to that as your balance sheet. So, simple accounting. So your assets and your liabilities. And your assets can be any retirement accounts that you may have, whether that be 401ks, 403bs, a checking and savings account. And then your liabilities are credit card debt, student loan debt, a mortgage, things like that. So having a place where you can easily access that and see that is vitally important to get a good grasp on where you stand. The picture that you see on the slide there is just a typical example of what your net worth is. So it's your assets minus any debt, or what you may refer to as your liabilities. So having a grasp on where you sit from that standpoint is good. The next numbers to really look at are your cash flow. So this is money coming in compared to money going out on a monthly basis. So where do you fall? Are you at a surplus in your income? Are you at a deficit, and maybe you need to get rid of some of your expenses? And these two items, there's a lot of financial planning software that's out there and that's available. So I highly encourage you. You can do this the old school way and kind of look it up and have it on an Excel sheet that you track and put your numbers in that way. Or you can automate that, and a lot of the websites now will allow you to sync your online login accounts, and that way it can give you up-to-date transaction tracking, so you can see exactly where you stand from a cash flow perspective. Because obviously that's one of the more vital things to keep and be able to see where you stand. If you have excess savings, maybe you can put that money into some other bucket, or if times get tight, if you, get laid off, furloughed, things like that, you can see, are there any unnecessary expenses? Maybe there's a subscription that you no longer use to a gym or Hulu, Netflix, things like that, a free trial that you signed up for and forgot to close out. So really diving into where's your money going. Most of this information can be found online through your bank. They should have a way to track, what's coming in and out of your checking and savings accounts and your credit cards. So highly encourage you to do that. This is a picture. This is something that I use for my clients. It's their own financial website, so it can track in there their net worth data, gives an up-to-date balance on that. They can plug in the goals that they have, short-term and long-term. And then the last thing is it tracks spending, so you can see exactly where that money is coming in and where it's going out. So come up with whatever system works best for you, whether that be electronically through an app. You can reach out to me. I'm happy to help you get your own financial website set up. I'm happy to do that, but make sure that you have a grasp on your money and where your money's going. Michael, have you ever used anything like that? Any sort of budgeting tools?
Yeah, I have. I was given a great, I did it the old fashioned way for a long time on the Excel sheet for a good while. I was given a really great Excel sheet model for tracking expenses, especially for cash flow. But more recently, I've been moving over to Mint personally. I've been having great experience with that.
Yeah.
Later on, I'd like to hear more about if you have any particular ones. Obviously, you've done a lot of work with this. If you have any personal favorites as well.
Yes. Yeah, absolutely. Yeah, I've definitely have tried them all. I definitely have explored with the different options that are out there. So, yeah, happy to discuss those with you. And then the next step to look at is to build an emergency fund. So a lot of people refer to it as emergency fund or a rainy day fund, from what you may hear. And this is money that you can quickly access in the case of an emergency or some unforeseen expense that you may have. So this is money that you wouldn't want to have invested in the stock market. It's money that's in a checking or savings account or money market type of account that you have there. You can use it. And that way it can prevent you from having to pull money from a retirement account early and paying penalties and taxes on that, or racking up a credit card, which could lead to a very high interest rate for you. So the key to building an emergency fund, one of the things that you can look at if you follow the steps and have kind of your budget laid out there and you know what your expenses are on a monthly basis. A couple of the rule of thumbs. I know many of you may have heard of Dave Ramsey. Typically his rule of thumb is 3 to 6 months of expenses you should have set aside in cash in a checking or savings account. And then that way, if you were to lose your job or had an unforeseen medical expense, or your car breaks down, your AC unit goes out in your home, things like that it happens. Obviously it happens to everyone, and no one can really plan for when that might happen. But those are the factors to consider. Is how stable is your job? Are there any medical expenses that you know of that may be coming up? And then things like normal, ordinary repairs to your home and your cars are obviously important to have in your mind. So I wrote so this link here, this where to put your money. I recently wrote a blog article on this, and it's up on my website. So that link will take you to that article that kind of walks through the exact process for that. One thing I will add to this slide right now is, with the wave of layoffs that we've seen recently, and I talked to a couple clients last week that, one had been laid off and the other ones are worried that it might happen soon. So now might be a good time to have a little bit extra, maybe lean towards, 5 or 6 months of living expenses in cash, just in case, we're not in the best economic shape right now. So erring to the side of caution with building up a larger emergency fund as we kind of weather the storm, through the rest of this year, is something that I'm stressing to a lot of clients and people I speak with. And as far as where to put that money, so there are some online banks, Ally being one. There's a couple other that don't have brick and mortar branches that may offer you a higher interest rate. However, interest rates are very low right now. The Federal Reserve came out and said that they do not plan on raising those anytime soon. So really, if you're more comfortable with going to a traditional bank with the brick and mortar branch, by all means, go ahead and do that. You're really not going to be losing out on a ton of interest that you could have gotten. In places to avoid, so obviously this money is not money that you would want to place in the stock market. So don't have this money invested in mutual funds, stocks, ETFs, because that money is obviously fluctuating every day that the market is open and trading. So the money that you thought was there might not be there for you if you got that money invested. All right. So moving right along here, the next step is to pay off what I would refer to as bad debt. So bad debt is something that you are not putting towards some sort of asset or something that you're not going to use that's going to generate income for yourself. So an example of bad debt would be credit cards that you're racking up, or a Macy's store card that you're putting Christmas presents on, or new clothes, or things like that. And the reason why this is bad debt is, one, the interest rates on some of these credit cards can be as high as 15 to 20%. And then two, yes, you have the short-term satisfaction of purchasing those things, but in the long term, they're not really generating income for you, and they're not, kind of setting you up for success. And bad debt is different from, good debt, which, a student loan, if a college education is going to propel you on to better things in the future, and you'll see a good return on that money, then that would be considered good debt. A mortgage is also considered good debt because that is an asset that hopefully eventually one day you'll own outright, or you'll be able to sell that and get money back, or if it's used towards some sort of rental property where you're getting income from that. So that would be the next step, is to get rid of those credit cards, or any bad debt that you may have. Get rid of those high interest rates, because that, although they have minimum payments on there, if you only pay the minimum payment, that credit card balance is just going to keep rising and rising and rising, and that's much higher than what you can get on average in the stock market. So make sure you get those credit cards paid off. Couple of quick ratios to be aware of. So consumer debt, that's things like, on your credit card, maybe that's eating out or clothes, things like that. That should not exceed more than 20% of your monthly net income. So housing debt ratio, this is something for anyone that's preparing to buy a house, something that you should be aware of and keep in the back of your mind. So if you were to look at your housing debt and what they refer to as non-discretionary housing cost, or what we may refer to as PITA, P-I-T-I. So that is principal, interest, taxes, and insurance. Those all are associated with owning a home, and those are associated with your housing costs. That number should not be greater than 28% of your monthly gross income. So that's something to be aware of. Just kind of a rule of thumb. You don't want to be house poor, as the saying goes. If you go to a mortgage lender, they might approve you for more than realistically you should be spending on a home. So look at that number, look at what you're paying in your principal, interest, taxes, and insurance, and try to make sure that number is not exceeding 28% of your gross income. And then the last ratio a lot of banks will look at is your debt to income ratio. So that is saying, of your monthly debt payments and your house cost, how does that compare to your gross income that is coming in? And they like to see that number be less than 36% of your monthly income. So all debt payments plus your housing costs, they want that lower than 36%. That can help you with, that'll help with your credit score. That'll help with getting approved for a home. It can maybe get you even a better interest rate as well. So Michael, have you run the numbers on any of that, any of that information, or anything else in
Not
common?
having a house, I don't have a housing debt ratio. Consumer debt ratio is actually just something that I had discussed recently with my own financial advisor this year. And yeah, it's an important thing to keep track of, and it's not something that I had ever looked at directly before. So
Mhm.
it's become kind of really one of the core pieces of my new sort of saving strategy and my new financial security strategy is making sure that those numbers are aligned.
Yeah, yeah, that's great. Yeah, it's important. You don't want to get, you don't want to get it in over your head because,
Right.
things can change, obviously. So it's important to know those numbers. And then once you've got that taken care of and you've paid off your credit cards or any high interest debt that you may have, it's very critical to start to save for your future. So having your goals established obviously play a key role in this part. If you're saving for either a short-term goal or a long-term goal, there's definitely things that you can do um, that you can do differently in different types of accounts. However, you always need to make sure that you're preparing for your future. I talk to a lot of young people, and a lot of them say, having a house is more important right now, or I need to save up for a new car, and they're putting money into those spots instead of saving for their future, thinking that I've got 30 years until retirement. I'm good. I'll save later once I get these things. And really, that is the polar opposite of how you should be thinking about retirement savings. Because right now, if you are younger, if you're starting off your career, the more you can put away now towards retirement, the greater the chances that that money can grow and compound for you. So compounded returns on the market, your interest can grow, and that can really set yourself up for not only retirement, but even in the middle of your career. Even if you're in your 40s or 45s, and something happens, you want to change jobs, maybe you want to change careers. If you've got money set aside towards retirement that you've built up, that is growing, that can give you more flexibility all throughout your career. So as soon as you start working and you've done those steps, you've got an emergency fund, you've got the debt paid off, really start to look to save for your future. And the easiest ways to do these are, if your company has a 401k or a 403b plan, make sure that you're contributing into that and you're at least getting 100% of the company match if that's offered. If it's offered, make sure you know what that is. Make sure you're saving at least that percentage, because that is, if they match 100%, an example of it, if they match 100% up to say 5%, you put in 5%, that's a 100% return on your money. And that's free money that you don't want to leave on the table. So make sure you're taking advantage of that. There's a couple ways to do it. There's pre-tax ways of saving for retirement, meaning the money's not taxed at the time you put it in. Instead, it's taxed at retirement when you start to take the money out. And then another good vehicle for people if they're younger in their career are Roth IRAs, or if your company offers them, Roth 401ks. The difference with those is that money is taxed up front, and then it's placed into your retirement account, and then that money can grow for the next 10, 15, 20 years. Then once you reach age 59 and a half or older, you can take that money out of those retirement accounts completely tax free. So happy to elaborate on the difference between what's Roth retirement savings versus pre-tax retirement savings. If you have questions on that, please let me know. Typically, the benchmark that I say for people that are starting out is try to save at least 10% towards retirement. That's including the company match that you may have. So if you say 5% and the company matches 5%, that would put you at 10%. Try to do that. Try to at least get there. And if you can, if things work out well, then you can bump it up to 15%. That's even better. I recently saw a study online from Fidelity that they published, and it went over certain benchmarks that you can have of amounts that it believes you should have saved towards retirement throughout different years of your career. So as you can see from the chart here, and they based it off of your salary. So at the age of 30, you should have at least whatever your annual salary is, have that amount saved towards retirement. Then when you reach age 35, you should have double your salary saved towards retirement, and so on down, as you can see from that chart. And the end all and kind of the reasoning behind that is once you reach retirement age, they say you may need as much as 10 times your annual salary saved into retirement to not run out of money. So that's the that's the Save for Retirement discussion. Like I said, if you do it now, if you're saving for your future, it can provide you with more flexibility. Obviously, establishing your goals. If you have shorter term goals, you can look to save that money in different types of accounts besides retirement accounts. But you still need to make sure that you're set up for success for your future as well. All right. So last step here. So diversify. Diversify. We talked about, kind of putting the money away and saving it. So now diversification talks about where the money is going. So Michael, you said you recently met with your financial advisor. Did he mention anything about stocks, or did he kind of go over what stocks are at all?
Oh yeah, that's actually a recent discussion for me. He said, you've reached a great financial point. Next step is to start talking about getting aggressive with your money and being foot forward with how you look at diversifying what you do with it. And so so I'm really excited to get started on that journey.
All right. Well, great. Yeah. So it's important to diversify your money. So once you're saving and you're building for retirement, and diversification simply means it's that old saying of, not putting all your eggs in one basket. So it's to spread your money around between different types of investments. And when you're saving, there are essentially, when you're investing your money, there's 3 different buckets where you can put it. And that would be stocks, bonds, and cash. So the difference between those are, so a stock essentially establishes ownership in a company. So in Cincinnati, one of the best examples of that is Procter & Gamble. So if you believe that Procter & Gamble is a great company and you think that they have great products, great leadership, you may want to own a piece of Procter & Gamble. So you can buy stock in Procter & Gamble with the expectation that that stock, say you buy it at, today it's trading around $118. So you pay $118, you get 1 share of stock in Procter & Gamble. Your expectation is for that money to continue to increase. And with that, you are taking on some risk. So if anything were to happen to Procter & Gamble, or maybe their products weren't going as well as they thought, or the leadership team wasn't, there is risk that stock could lose value. However, over the long term, stocks have been the best way. Over a 20 or 30 year time period, stocks tend to average around a 10% return. So if you establish that money is for a long-term goal, then it makes more sense to have a higher percentage of that money be invested in stocks. And if you compare that to bonds, so bonds are a debt instrument. So the way that it works is, Thomas More, if they wanted to build a new stadium, they could say, we're going to issue bonds to help to fund the new stadium. And what a bond says is, if you give us $1,000, we're going to hold that $1,000 for 10 years. At the end of 10 years, we'll give you $1,000 back. However, during the lifetime of that bond, during that 10 years, we're going to pay you interest. We're going to pay you 5% interest twice a year for 10 years. So essentially, you'll get your $1,000 back plus the interest that you own. And these are a great option for people that are looking to be more conservative with their money. These are an option for people that are in retirement and want to get a good interest payment. So that's where bonds come into play. Bonds, you're not going to get as high of a return as you would from stocks, but they're more of that slow and steady conservative type investment. And then cash is no different than you would see in a normal checking or savings account. You're going to get a very, very low interest rate on that. However, you're not going to lose money. So, the purpose of the cash is just to stay at $1 per share and hold its value. So it's obviously the most conservative bucket of money that you can have. So then with that, there's different asset categories amongst each group. As you can see from the chart there, I won't get into too much detail about that. It tends to get a little bit confusing, but amongst stocks, there are things like large cap stocks. An example of a large cap stock would be Procter & Gamble or IBM. And then there are small cap stocks. And an example of that would be like First Financial Bank locally. That would be a small cap stock compared to a large cap stock like JP Morgan Chase. So the small cap stocks are more risky than large caps. And that's simply because of their size. A small cap company could potentially double in size, whereas a large cap company tends to not double in size. They tend to just be more slow and steady. So that's kind of the risk and reward relationship that you take when you're investing your money. If you are comfortable with taking more risk, if your goals are longer term goals, you can afford to have more of your money invested into stocks than you can in bonds. If it's a short-term goal, I'd say 2 years or less, you'd want to have that money in cash. And even if the goal is 3 to 5 years away, you want to have that money in a very conservative bucket, either very short-term bonds or cash. And the reason why I throw out that number is because when the market takes a big drop, so we saw the market take a big drop this year in March. The market took a big drop in 2008. On average, it tends to take around 4 years to get that money back, to get the stock market back up to the levels that it was previously. This past drop in the market that happened in March was the fastest drop we've ever seen, and it was also the fastest bounce back up that we've ever seen as well. That was very different from what we saw in 2008, which took kind of a number of years to get that money back. So that's why it's important to assign a goal to your different, I call it the bucketing approach. Assign a goal to the different dollars that you have. If it's a long-term goal, invest it more heavily in stock. If it's a short-term goal, you want it in short-term bonds or cash. So Michael, any questions that you may have on that, or is that confusing at all?
Oh yeah, well, I mean, diversifying your funds is super important, and quite frankly, a little bit complicated, especially once you get on the stock side. I personally don't have a lot of experience or knowledge. I've never been a guy that's watched the markets or anything like that. So this information is great, and having discussions and conversations with people that do know about it, that are professionals in the area, is just invaluable. It has been for me so far.
Yeah, definitely. And one of the easiest ways to get started, if you're not 100% sure where you should put your money, and what you may have seen recently, and Michael, you and I have actually talked about this, is there's different ways where you can start to get invested your money, and there's things like Robinhood that are becoming more and more popular. People looking at it almost as if it's comparable to gambling or something like that, which is, it's not how you should look at stocks, and you could potentially lose a lot of money by doing it that way. So what I recommend for people that are just getting started, it's nearly impossible to pick out individual stocks successfully during a long period of time. There are people on Wall Street that are paid lots and lots of money to try to do it, and only about 60% of them can do it. And that's just over a short time period. If you extend that out to 20 or 30 years, there's even fewer. Only about 4% of the stock pickers on Wall Street can beat the market. which is, the S&P 500. So an easy way to get started is just by looking at what they call an index fund. Vanguard has them. They're kind of the most famous for them. But you can essentially buy the entire stock market. So the S&P 500 is 500 stocks. You can own a small piece of all of them. And it's a way to get diversification and take some of the risk off the table of just trying to pick one or two companies that would work best for you. And then the last piece I will say around diversifying is, if you can do it, building multiple streams of income. So, when I was younger, I worked, I started right out of Thomas More. I started at Fidelity Investments. So I had the income coming in from Fidelity. But one of the things I did was I refereed basketball games. So that was during the winter. That was 3 to 4 months right there, and it was some extra money that came in on a weekly basis for refereeing basketball games. And now more than ever, you've seen it. They call it the gig economy, but if you can, that is another way to be financially secure, is if you can start to build out multiple streams of income, whether that be, if you got a master's degree, maybe you can be an adjunct professor at Thomas More. Maybe you can tutor kids online or teach classes in addition to your normal 9-to-5 day job. There's things where you can freelance online, Uber, things like that. And one of the more popular ways I've seen it is people investing in real estate. People owning apartments or condos and renting those out. So if you can find a way, I saw a stat that the average millionaire has 7 streams of income. If you can start to at least think about that and see, what are some good ways that you can provide a couple different streams of income, that's also a way to kind of be secure in your finances and in your future.
Well, thank you so much, John. This has all been phenomenal information and
Yep.
more relevant than ever for so many people. I mean, feeling secure financially right now, if you can achieve it, is, just gold, especially with, people are in a lot of unstable states. So this information is incredibly, incredibly useful. If you got a bit more time, I'd like to throw it over for some Q&A. If you've got a minute. Well, great.
Sure.
We do have a question in the chat right now. So they want to know whether you have an opinion on where you think the next bubble might be coming from and on where investments are strongest right now. Obviously, 2008 was a housing bubble. There's been a lot of chat since 2008 about whether or not there's another sort of financial bubble on the horizon, whether it's in a different market or back in housing. Right. And do you have any opinions on that?
Yeah, there are. I mean, there's obviously been talks, from everything I've read. One of the biggest fears is, the student loans. So the amount of student loan debt that's out there in the market is growing steadily and continues to grow. So that is one thing that they see that could potentially be worse than the mortgage crisis that we saw if there's just waves and waves of people that start to default on their student loans. So to kind of combat that a little bit, there are, there's loan consolidation services. There are, with the CARES Act that you may have recently seen, they've actually allowed you to put your loan into deferment and kind of delay the payments on those until you maybe get your feet under you or a strong foundation. But yeah, that is definitely one area. And then the second area more recently that people are worried about is commercial real estate. So if more and more companies, if the work from home is here to stay, and if you see more and more bankruptcies from bigger companies, that could lead to a downturn in commercial real estate, just because people no longer need the office space. As you may have seen it in the news, Cheesecake Factory, they came out right away and said that they're no longer paying their rent for any of their locations. So that the the money, the PPP loans that have hit the market seemed to have provided a good enough buffer for right now. However, if there's not a second, or let's say a third or fourth round of the PPP money, um, a lot of these companies, you could see more bankruptcies. You could see, a lot of these companies that their employees didn't return back to work, or they're not going back to their office space. You could start to see a lot more bankruptcies and things along that line in the commercial real estate world.
Both are really concerning, and I hope that we see more information come out about how the market is handling those, how people are addressing those issues. But in terms of
Yeah,
monitoring issues like that, uh, there's so much noise around finances. Whether it's the podcasts that you listen to, the television news that you watch, the newspapers that you read. It can be kind of difficult to parse how much information there is and find good information and good information providers among a kind of a sea of noise. Do you have any advice or favorite outlets or writers that you think provide good information that's reliable?
yeah. So, there's a couple things. So I actually took a course to be certified for a Dave Ramsey financial coach. I think Dave Ramsey's information, his material can be very good. He kind of takes it to the extreme as far as, cutting credit cards and, absolutely no debt at all. I think that's a little much. I think as long as you have a credit card and you pay it off on a monthly basis, you'll be okay. But Dave Ramsey, I think is a good place to start if you're looking at, personal finance information and, learning how to safely, save money and build that emergency fund. I think his baby steps that he has come up with are good. And then as you're kind of building your wealth and looking to invest, getting more and more comfortable with that, there are a couple firms that provide good, investor education. One of them is Vanguard. So Vanguard's website, they're the big mutual fund company, the big index company. They have a lot of good material and resources on their website that you can use, that can show you, where the market is going. There's also, and you did mention Robinhood. Robinhood has good videos on there and good, resources that you can use. Just need to be careful to not kind of fall into the bait of trying to pick individual stocks with them. But
Right.
I definitely think some of the books that Dave Ramsey's written are good on money, and a good place to start.
Well, great. Yeah, Dave Ramsey's materials I've seen before. Definitely some great strategies and approachable strategies. And approachable is kind of one of the last things I want to mention. Many people are playing a real juggling game between either, monthly expenses, rent or house payments, various debt, student loans, car loans, and then also trying to save. And you talked about, you mentioned one of my personal favorite pieces of financial advice, which is have a purpose for every dollar and setting those priorities. How would you approach starting that if, say, you maybe aren't in the best financial state at the moment and you want to start turning that around? Where do you start?
Yeah, definitely. I think one place to start is simply just to start small. If you can build it to just $1,000 in an emergency fund, try to start there. Have some cash kind of set aside.
Yeah.
And then the next place to look at what debt you have and look at the interest rates that are on that debt. So if it's a credit card and it's a 15% interest rate, you're not going to do better than that in the stock market. So, look to pay down that credit card.
Right.
If it's a student loan debt and it's a federal student loan and the interest rate is high on that, I'd say, 8 or 9%. Look to consolidate that or look to even refinance that. There's a lot of companies now that are offering good rates for that. So, first look to that, have that $1,000 in an emergency fund. Second thing to look at is what are the interest rates? If the market over a 20-year, 30-year time period averages 10%, but the money is more short term, I would say take the guarantee of paying off the debt. And then as far as the next place to look would be, does your company offer any sort of match on their retirement savings? So if they do, make sure you're taking full advantage of that match. That will at least kind of check the box for your long-term bucket of money. And then after those steps, so after the emergency fund, pay down high interest rate debt, take advantage of your employer match. Then after that, start to build money in a brokerage account or some sort of savings account towards, whether that be a car, a home, starting a family, things like that.
All fantastic advice, and it's approachable. The steps that you can take, depending on your financial circumstances, those can be steps you can take in your own time, and hopefully can be really helpful and fruitful. Well, John, thank you so much for joining us. This has all been fantastic information. I really appreciate having you here to share it with us today. Thank you so much for sharing with the Thomas More community on MORETalks. Again, we will be sending this out as a video. This has been recorded, so if you want to review the information, we can do that at more.thomasmore.edu. And John's information, if you'd like to contact him, is on the screen now. Again, John, couldn't thank you enough for being here today.
Yes, thanks for having me. I appreciate the time.
All right, you have a wonderful rest of your day.
All right, thanks. You too.
Bye-bye.